These are the 7 long-term stock to buy and hold for 2023. Not recommendations, this is just what we are doing. In no particular order, Google. All-time highs of $151, currently down 36%. 36% in the stock market, that is quite something. We're talking about Google here. It is the most commonly known and used search engine, right? Although the company made its name as a search engine, the vast majority of its income comes from other things, advertising, for example, and it's branched out into a number of areas such as cloud computing, software, and hardware. They have a positive economic outlook with a growth of projected growth of 10% earnings per share over the next 5 years. Especially with a great strategy, what is there not to like on that one? That's just our opinion. Next one has got to be Amazon. No particular order. Look, it was at 185%. Yeah, maybe a little bit overvalued. Currently down 46%. That's insane. It originally started as an online book selling company, as you know, but then it morphed into an internet-based business enterprise that is largely focused on providing e-commerce, cloud computing, digital streaming, and artificial intelligence services. It really is the market leader, and despite Corona and the challenging years of 2020 and 21, they have grown their earnings per share from $1.17 to $3.30 last year. The outlook looks extremely positive for the coming years as well, so make sure you do your research. Next one, Apple. All-time high of $182, currently down 18%. They're holding quite strong, but it really is one of the most valuable companies in the world. Now, as you know Apple, right? It produces popular digital gadgets, Macs, iPods, iPhones, iPads, etc. Apple are at the forefront of technology, that's why, and are also adapting to new technologies, even such as the blockchain, right? They have a profit margin of 25.3%. That is good. For a company that size, that's insane, even though they are a global company with thousands of employees. Next one, this is a safe bet, right? Microsoft. All-time highs of $349, currently down 29%. You know Microsoft, right? Leading developer of personal computing software system and applications like Word, Excel, PowerPoint, you know them, right? The company also publishes books and multimedia titles, produces its own line of hybrid tablet computers, offers email services, sells electronic game systems, computer peripherals, input-output devices. They have a return on equity of 42.3%. What does that mean? Well, it means they're financially sound. They also have a low debt-to-equity ratio of just 0.36. They don't have hardly any debt, which means they are very likely to sustain tough times, right? So, a safe one there. Not so safe, maybe, Tesla. All-time highs of $414, currently down 52%. Now, you know Tesla, right? Automotive and energy company. Yeah, an energy company, because it designs, develops, manufactures, sells, and leases electric vehicles, but also energy generation and storage systems. Tesla has had an incredible growth over the last couple of years and has outperformed all the other US car manufacturers put together. That's not bad. They have zero debt and are projected to grow 48% a year over the next 5 years. Now, that is a projection, of course, but still. Here's another really safe one. J&J. All-time highs of $186, currently down only 9%, because this thing is solid. Manufactures healthcare products, provides related services, right? Johnson & Johnson, right? For the consumer pharmaceutical and medical devices market. Profit margins of 19.9%. That's pretty good in that sector. It's the market leader, steady despite big drops in the market. It's only down 9%. Last but by no means least, it's a little bit like Johnson & Johnson, just different. All-time highs of $165, only down 14%. So Procter and Gamble, what does it do? It's the biggest consumer goods company in the world. Mainly manufactures laundry and cleaning supply products, as well as products in the cosmetics and personal care sector. Same as with Johnson & Johnson, it is the market leader in their field. It has very, very low debt. And despite being one of the biggest, it has a projected growth of 9.5% a year over the next 5 years. For that sector, that is good. I believe a secure and stable investment, but as always, make sure that you just use us as a springboard to do your own research. So rather than have to look at 7,000 of these things, here's 7 that you can have a look at to do your own research and make your own decisions on. Okay, so very, very important. Next steps for you is what? Hit that subscribe button to make sure that you get these high quality, high content videos sent to you and alerted. So I think you have to ring that bell as well, right? So that you know that the next one is coming. Then you can always use us to do your research. And it would be great if you could hit that like button as well, because it does help with the algorithm. But do make sure that you do subscribe so you don't miss out, okay? And we look forward to seeing you on the next video.